Hello students, welcome to Legacy Eyes Academy. In today's video, we are going to discuss about the recent decision that has been taken to include the government bonds of India into a well-known global index, that is the JP Morgan Index. So what is the overall impact which we can expect due to the inclusion of the government bonds in this index, and whether it will attract more foreign funds toward India? If yes, what are the other ramifications of this, what we will see on the Indian economy? Let us try to understand and discuss in more detail. So first of all, to give you the background of this particular topic, the government of India's bond, or what you can say Indian government bonds, have been included in the JP Morgan's emerging market, or also called as JP Morgan EM bond indexes, and this will begin from the coming Friday, that is from tomorrow, 28th of June. So the inclusion is likely to bring, as per many experts, the number varies, but overall everyone agrees that at least 20 to 25 billion dollars will be brought into India, will be brought into the country, and this some estimates also put this number, pick this number higher to almost 40 to 45 billion dollars after the inclusion. So these higher inflow obviously will help India financially and will help India manage its external finances, as forex reserves will show up, and also India will be able to manage its fiscal and current account deficit. But on the downward side, on the negative side, we can also see RBI facing problem in fighting or curbing the inflation, because such huge amount of forex inflow will cause an upward pressure on the inflation in India. Now let us try to understand this entire issue in more detail. So first of all, if we talk about the inclusion itself, now India will be included. Now it is the JP Morgan. So JP Morgan has recently announced, made a statement that India will now be included in the JP Morgan GPI-EM Global Index Suite and all relevant derivative benchmarks, including custom indexes. That means GBI EM Global Index, it is a larger index. Within that you have a lot of sub indexes. So in all of these sub indexes, Government of India bond will start trading. The inclusion of Indian bonds will not happen, what we can say, in a single instant, but rather it will be staggered over a period of 10 months. So beginning from the June 28th, that is from tomorrow, and for next 10 months continuously and gradually, the Government of India's bond will be included on this index. India is expected to reach the maximum weight of 10% in the GBI-EM Global Diversified Index, and a higher weightage. Basically, as the bond start to be included, gradually the weightage will rise, and after 10 months, basically when India achieve its 10%, that is the maximum weightage a particular country's bond can have on the index, in that case it will prompt the global investors to allocate more and more funds for investment in the Indian debt. Why Indian debt? Because the Government of India's bond, the government securities, are nothing but an example of instrument of the debt fund. Now if we try to understand that whether all kind of bonds can be included here, or is there some fixed criteria. So if you talk about the which bonds will be included, so as of now there are 23 different bonds of Government of India with a combined notional value of approximately 27 lakh crore or 330 billion dollars, which are eligible to be listed on this JP Morgan index. And in this context, JP Morgan has said that only such Indian government bonds which has been designated under the FAR route, that is fully accessible route, are index eligible. Now what is the fully accessible route, or FAR? Here FAR stand for a kind of mechanism, kind of separate mechanism, separate channel that was devised by the Reserve Bank of India in consultation with the Government of India, which enable the non-residents of India. It includes all the foreigners, people of Indian origin who are living outside, or even NRIs, to invest in a specified Government of India dated security. So only those security which has been designated under this route will be actually eligible to be listed on this JP Morgan index. Now apart from that, the JP Morgan itself has certain eligibility criteria for the bond to be listed on this index. What is this eligibility criteria? So it says that only such bonds which have a notional outstanding of above $1 billion, you can convert equivalent in the Indian currency, and at least 2.5 years remaining maturity, those can only be listed on this particular index. What it means? It means if you talk especially about 2.5 years, you know that Government of India issues bonds for several years, for a certain time duration. It can be 7 years bond, it can be 10 years bond. So for example, if a 10-year bond is there and 9-year time period already has elapsed, in that case this kind of bond cannot be listed here. So minimum 2.5 years of remaining period should be there before the bond actually becomes mature. So this is about the eligibility and inclusion of the bond. Now let us try to understand the most important topic, that what is going to be the impact of the inclusion. So first of all, as I discussed already, as per many experts, almost 20 to 25 billion dollars of the US dollar will actively flow into the debt market of India, which remains under penetrated on the external financing. Whatever debt government of India raises by issuance of the bond is largely raised from the domestic sources. This can be domestic banks, this can be domestic investors and companies and all. Second, thus as a large amount of forex reserve will inflow into India, it will help India manage and finance its twin deficit, the twin deficit which stands for fiscal deficit and the current account deficit. Third, enhance the liquidity and ownership base of the government security. Same point is that because currently most of the government bonds are held by the Indian companies, Indian banks, Indian shareholders or Indian citizens. So in that case, there is a lack of diversity. So this will help in improving the diversity. And at the same time, as more and more bonds chase money not only within India but from outside of India, it will also help it make much more liquid in nature as more and more cash will flow. Fourth, we can understand that it will also help in supporting the diversification of the investor base for Indian government security, and basically because of the same reasons as discussed before. Last, we can discuss that less pressure on commercial banks. Now what is happening right now these days, because government securities or government bonds are sold in India itself, and largely it is the banks who are pressurized or who basically are encouraged to buy this bond. So if the banks are investing more and more money into the bonds, obviously they will have lesser money left with themselves to lend to the private players. And thus, as now the bond can seek market even outside of India, in this case the bank or the banking sector will have increased exposure to the private sector lending in the economy. That will help in boosting the growth of the infrastructure, boosting the development of businesses, increasing overall we can say profit turnaround ratio of the businesses, and also can increase the profitability of banking sector itself. Why? Because if the banks are investing in bond, they will get only a certain fixed amount of interest. On the other hand, if you are lending to the private player, obviously as the risk is higher, they will charge higher rate of interest, and this can help in increasing and improving their balance sheet. Obviously there is downside to it, in just in case if default happens, then obviously the stressed assets of the bank will also increase. But overall, positively if you try to understand, bank will reap benefit because of this decision or this step the government. Now what is the concern for the RBI? So obviously higher the amount of inflow of foreign exchange or foreign money into India, higher will be the inflation, or inflation is likely to come under pressure. So when the basically what happens when the RBI takes away dollars from the market, mops up the dollars from the market that is inflowing into India, it will have to release an equivalent amount of rupees into the market. So what will happen? The supply of rupee, the Indian rupee, Indian currency will increase, and as the supply of Indian rupee increases, obviously more money will chase lesser goods, and due to this there will be an upward pressure in inflation where the cost of goods and services might start and begin to rise. However, the Shaktikant Das, who is the present governor of Reserve Bank of India, he has said that currently the central bank is more than capable enough and has several instruments to manage surges in the flows on account of bond inclusion. And he also made a clear statement that India has dealt with such situation before, and even RBI has full capacity to deal with any upward pressure on the inflation due to this particular steps. So nothing to worry about on this front. However, the inclusion of India into this particular index also paves the way for inclusion of Indian government of India's bond on the other similar prestigious indexes also. And in this context, already we have seen the announcement was made by another important company, major company, that is Bloomberg, that Bloomberg will now allow the government of India's bond to be listed in Bloomberg Emerging Market Local Currency Government Index and related indexes from next year, that is 31st of January 2025. Now, what are the scope for inclusion here? So, Bloomberg EM Local Currency Government Index, Bloomberg EM Local Currency Government Index 10% Country Capped Index, and all related sub indexes where Government of India bond can start trading from the next year itself. And the other one we have is FTSE Index. So, obviously, experts believe that once Government of India's bond begins trading on these two indexes, in next year or so, we can see the listing of the bonds on the FTSE Index as well. So, all the three major indexes will obviously increase the demand of Government of India security, bringing huge amount of cash foreign exchange into Indian economy. The challenges are also there, and challenges are largely on the operational front. So operational hurdles will need to be ironed out, and these includes the ability of government to clear and settle Indian debt on an international platform like Euroclear. For example, if a foreign investor is buying Government of India's bond from any of these indexes that is listed here, obviously Government of India will have to make a provision to pay them their money back once they decide to sell the bond or once the bond has matured. So for that also a lot of operational challenges are there that need to be cleared. Second, the repatriation of fund once bond is sold and the fund is again taken into the Government of India's account. For example, after buying of the bond by the foreign investors, then how the fund has to be brought back to India. For that also mechanism need to be there. And last, the tax complexities, and on the tax law there need to be some work that need to be done, because it includes removing or lowering the capital gains tax compared to what a domestic investor would pay. For example, there should be parity between how much tax a foreign investor is paying and how much tax a domestic investor is paying in case one is selling the bond after maturity, reaping benefits out of it. But overall, what we can see in conclusion, that over time the ongoing reform process that we are seeing in the financial institution, financial sector, easier market access, the example of this which we are already discussing right now, and the transparency largely due to the digitization of the entire process, it will shape and hasten the country's integration into the global markets. In 1991, when India opened its economy, it became economically integrated to the other markets, to the other part of the world also, in terms of the supply and exchange of goods and services, especially after the LPG, that is liberalization, privatization and globalization era. So this is something we can say the second stage of the reform, where now the Indian market is being integrated into the global markets. Second, it will pave the way for a landscape of plethora of things. For example, unparalleled market development that will happen, long-term capital inflow, and innovative financial products will be designed to lure and attract more and more investors. Long-term capital inflow is very important because the Government of India's bond, which is having 7 years, 10 years maturity, obviously if someone is buying those bonds for 7 to 10 years, government will have money for that, which it can use for a variety of purposes, including infrastructure development, including spending on these social issues as well. So that is overall what we can understand about the overall ramifications of this step that has been taken recently. That is all for this particular video. Thank you very much.